Good morning. It's Thursday the 30th. What do you need to know? Well, there's a lot. So let's start with the Fed. The market is questioning the Fed's credibility. Anna's about to show you the US 30-year. There has been a big move. Samsung's chip profits surging 250 times. It's also saying that the memory shortage will worsen. Get this, its stock is lower. And the US and Iran launching fresh strikes overnight. The oil price responding accordingly, moving higher, Anna.
Absolutely. Let's get to another story, because as if that weren't enough to manage this morning, we have a host of European earnings this morning to deal with. Lots of corporates reporting. In the context of that, Euro Stoxx 50 futures up 0.1%, trying to keep our heads amongst all of the drama in the tech story. This is what we see, as you mentioned, Guy, in the 30-year yield, 5.22%. Interestingly, it ticked up on the back of that, or moved higher substantially on the back of the Fed meeting, questioning perhaps then the inflation credibility of the Fed, and it hasn't budged lower again. It hasn't moved lower. It hasn't retreated back. So 5.22 is where we stay. Brent crude up by 1.5% this morning. We've seen a return to the tit-for-tat violence in the Middle East, and as a result, we have a higher oil price. The countdown to the opening trade starts right now.
OK, so let's get Thursday going. It's already going. It's been a massive story overnight. The Fed, the big move that we've seen in the 30-year, the complete kind of repricing, I think, to a certain extent, of where inflation expectations are likely to go. Look at where tips are. Basically, Warsh came out last night and said, I'm going to be hawkish. But the market only saw that as talk. It really wanted further action. And Anna, the Fed's credibility is now firmly on the line. If you look at the work function on the Bloomberg this morning, 66% probability of a Fed rate hike in September now priced.
Yes, indeed. I mean, is that, yes, there's the credibility line. Is it a questioning of the credibility? We saw the move at the long end of the US curve, as you mentioned. We've also seen a growing number of dissents at the Fed.
Yep.
And so perhaps if you took that as a signal, that could also add up to a higher probability. Maybe the Fed is building toward doing something, but this is only 3 out of all of the FOMC now talking about a rate hike. There is a slightly different interpretation. If you were looking for a more generous one, could you say that the Fed is trying to tighten with language and it's succeeding at doing it at the 30-year horizon? Maybe that's not where they want to tighten. But that is something that some people are talking about. But yes, a lot of people talking about a lack of credibility, because if you just talk and you don't act, where does that leave you? The
curve has steepened significantly. The market is pricing less at the front and more at the back. Basically, that's telling you that it hasn't got a handle on inflation. That's the message, clearly, from that steepening that we're getting out of the curve, I would argue. And certainly that seems to be the interpretation of an awful lot of people. I've read commentary after commentary out of bank after bank overnight saying the Fed needs to get a grip on this situation fairly quickly. It is going to be forced, therefore, to act, probably in September. I can't remember the last time the Fed went once. That probably implies that the Fed is going to go 2 or 3 times. What does that mean for other assets? Where does that take the 10-year? Where does that take the 30-year? Big questions, I think, this morning.
And the statement was only 115 words. This is a Federal Reserve that doesn't really want to say anything.
But
we
that's
have
the problem.
The meetings until the end of this year, but we might not even get those post-Fed decision meetings in the future. It's such a new Fed, and we're still all finding our way.
Let's talk tech.
Let's talk tech. We've had a lot of tech earnings out, of course, overnight and into this morning. So on the upside, on the positive side, you look at cloud, you look at Microsoft, what they're doing on the cloud side, up 43% in terms of those Azure revenues, growing the fastest pace since 2022. That's the upside. That stock up by 9% after hours. Samsung, also a positive story, a 250-fold increase in chip profits, as you said, above the estimates. But even there, you've got the negative around what's happening at their electronics unit, which includes phones. And there, you've got that dropping into a loss for the first time, and this is to do with memory and where where you're seeing the chip makers moving into the types of chips that data centers need. They're not making the types of chips that phone companies need. Even Samsung, that makes its own chips, isn't doing quite so much of that, and as a result it's harder on the phone side, and that weighs on ARM and it weighs on Qualcomm, which is the other tech story, which was more negative overnight.
Meta, also not good. So that's a narrative that we also need to fold in here. Another one of the hyperscalers that's talking about increasing in terms of its footprint on the capex spend, but also just kind of increasing in terms of the inflationary element to that spend. So it's talking about what leases look like on data centers. They're just going up and up, and it's moving guidance higher and higher. So the costs, therefore, continue to rise, and the market just doesn't like it. And you look at the move in Meta overnight, it is epic. These stocks are getting hammered if even slightly signal any concern around what the cost of the AI build-out now is going to look like.
Yes, and I do think it justifies why we keep asking CEOs and business leaders about return on investment around AI. Because it's one thing to say that you're spending a lot on CapEx, but what is that getting you in return? And the positive surprise at Microsoft and the negative surprise at Meta kind of illustrate the importance of those kinds of questions.
OK, let's talk about what is happening with the Iran story. We've seen further strikes. The US have hit IRGC sites in Iran. The Iranians look like they are hitting back again overnight as well. There's talk of targets being talk of targets in Jordan. You've got also a story kind of breaking around what is happening with LNG tankers on the Red Sea side of things, both at the bottom and increasingly at the top of the Red Sea. And I think this is just going to further cause concern. We've seen a dip in oil prices. They're now coming back up very sharply. How much further do they have to rise going into a weekend which, once again, could prove very tricky?
Yes, exactly. And some of the questionable activity, we're not sure exactly what it is, taking place even into the Mediterranean on the Egyptian coast. So a couple of LNG tankers there, the victims of hits from projectiles. Unclear what the source of those was, but there were fires on board, brought under control. But does this give us another geography to worry about? We're worried about the Strait of Hormuz. We worry about the Red Sea. Do we have to actually start thinking about that part of the Mediterranean? And in amongst that, we see US commercial stocks of oil at their lowest since 2018.
Okay.
The Strategic Petroleum Reserve down to the lowest since 1980.
So let's pull this all together. You've got a Fed that is struggling to get inflation under control. You've got an inflationary input that is coming in from energy. You've got the data center story, which Meta's kind of pointing us towards the inflationary impact there. You look at the 250-fold rise in profits at Samsung's chip business. Where does that? Do we have an inflationary situation that is under control? And how and have markets adjusted to that fully yet? I think is a question that I think is just kind of ringing around all aspects of what we're watching this morning.
Absolutely. How do you get anything under control when we see such volatility in the oil price? Let's move on to some of the earnings stories we've had out this morning then, Guy. And let's start with LSEG. So we get numbers out of London-listed LSEG. Full-year revenue at constant currencies. The forecast is 7 to 7.5% growth range. So that's sort of on the outlook side of things. The first half adjusted EBITDA coming in at 2.53 billion. The estimate was 2.49 billion. So that looks to be better than expected and raising that EBITDA margin guidance. So let's start the conversation there, shall we? We are joined now by David Schwimmer, who is here on set with us, the CEO of LSEG. David, good to see you this morning. Thank you so much for coming to speak to us on what is no doubt a busy day. So you're upgrading your guidance for the EBITDA margin. I wonder what visibility you have around the business, what leads you to be confident enough to do that upgrade today?
So we've had a record first half. This is the strongest performance that we have had since the acquisition of Refinitiv 5 years ago. We continue to improve our margin. We're getting great operating leverage out of the business. We're seeing strong traction with our new AI products. We've got thousands of users. And we do have a lot of confidence in the second half. So we have upped our full-year guidance on both EBITDA margin, but also tightened it on the revenue line as well. So feeling very, very good about the business. OK,
so lots to be positive about. You mentioned AI, and you were waiting patiently as we were just discussing some of the other themes going around these markets. So you won't be surprised if we ask you about return on investment in AI. What are you seeing there? What are you seeing for the amount of money you spend, for the innovation that unleashes, what you get in return? So
first of all, we're seeing significant benefits ourselves in terms of how we operate, in terms of the efficiencies internally, in terms of rolling out new product more quickly. Perhaps more importantly, we are seeing the product that we provide, the data, the content that we provide, being used very actively by our customers in terms of wanting to consume data through AI channels, whether that's LLMs, whether that's through their own technology stacks. And it's actually fascinating because here we are sort of 1 year in, if you will, from the wave of AI disruption last summer. And we can now see real evidence in a lot of areas where, for example, agents use roughly 10 times more data than a human in terms of our MCP channel. So the SaaSpocalypse drama overdone in terms of worrying about the LSEG business model then? Certainly. From our case, what we see, our revenues are higher, our sales are higher, our retention is higher, our margin is higher. We've got new products out there that our customers are using in this AI environment. Ironically, London is perceived as being the anti-AI trade right now. Do you think that's fair? Well, if you look at a lot of the big companies here, you've got banks, you've got energy companies that are doing very well in this environment. So I think that there are a lot of companies here that are doing a lot of innovative, great things. The market has not benefited, the market here has not benefited from, I'll call it, some of the froth in the U.S. or in Korea.
Yes.
And as we see some questions about that froth, we're seeing a lot of appetite for the great companies that we have here. We saw the FTSE hit a record this week.
Absolutely.
So, yeah.
Kind of picking up on that point, trading in Q1 was good. What's trading in Q2 look like?
So Q2 was a little slower than Q1. I would say a little bit more normalized compared to Q1, but also was compared to Liberation Day of last year, which was a huge Q2 last year. But overall, we saw a very strong Q2, which is, you put Q1, Q2, so we had this record first half. So,
how lumpy do you think that's going to be? It's interesting, I was talking to Sergio Mossi in Zurich yesterday, and he was saying he expects spikes of volatility going forward from here. That is effectively what we're going to be looking at as the new normal. How lumpy do you think quarter to quarter is therefore going to look like?
So we have had a lot of volatility in the first half. All the events that you all were talking about in terms of kicking things off this morning, it doesn't feel as if the volatility is going to slow down. And almost by definition, volatility tends to happen in spikes. So volatility is good for our business, whether we see that across the FX trading, the equity trading, the clearing we do of rates, the TradeWeb business. So I do expect, given what's going on, whether it's a question about inflation, whether it's a question about the geopolitics, I expect that we're in an environment where there will be, I'll say, persistent volatility.
Yeah, persistent volatility. And I wonder what opportunities lie in that then for investors of the human or the AI variety. You mentioned agents and the rate at which they want to consume data and use data. I wonder what kind of step change you're looking at then in your customer base. I mean, can we call it that, David? I mean, they're run by someone, so I guess there's always a human in the loop.
So what we're seeing is that our customers, whether big banks, hedge funds, asset managers, pension funds, sovereign wealth funds, the array, they're all trying to address this in slightly different ways. What we are often seeing is a mix, sort of a lot of kind of nuance, if you will, in terms of how our customers are incorporating AI into how they consume our data. Sometimes they're consuming our data through the MCP channel, Model Context Protocol servers, which is a very effective new distribution channel for us. Sometimes they have their own technology stacks, and they may be accessing our data through an API or other channels, and then bringing that into their own environment where they're applying the AI to it there. Sometimes they're accessing it on our workspace, our desktop product. So in many ways, lots of new capabilities, a lot of opportunity to use data in a, I'll say, more empowered way. Mm-hmm. We have so much data within our state that a human could never access, any kind of tiny percentage of it. So to have the agents, to have models accessing it, it's much more powerful for our customers.
I have to ask you about IPOs and whether you're concerned about possibly a couple of them that have been talked about coming through the summer, maybe being delayed. Does that tell us anything about the IPO pipeline and what difference 24/5 trading can make to that?
So with respect to the IPO pipeline, it is stronger now than it's been really since the financial crisis. The timing, of course, is dependent on each issuer. And here we are sort of in the depths of summer, unlikely to see a lot of IPOs coming over the next month or so. But I would expect in the fall, and then certainly going into 2027, we'll see a number of these. And they're reported on a regular basis in terms of companies choosing to come here. So that's looking good. We also have the private securities market, where we've seen some real traction there as well, with Wave and Moneybox and some others just going over the last month. So private companies able to access the London market, the London Stock Exchange infrastructure. You asked about LSE 24, which we have just announced. So we'll have basically 24-hour a day, 5 days a week trading the London Stock Exchange. Yeah. The initial products will be exchange-traded products. And then we may move on to equities further down the road. But this is seen as very attractive for typically either investors around the world, often in Asia, who want to get access to the markets out of our hours, and also for retail on a global basis.
Can I just say before we finish? This show's called the opening trade, okay? So that's going to cause us a few problems. I'm just going to point that one out. If you're going to do it 24 hours a day, I don't know what we're going to call the show.
We'll see what we can do for you here.
We need a new name.
Okay.
We'll work on that. David, thank you very much. Thanks so much for joining us. David Schwimmer, the LSEG CEO. And, of course, we should note Bloomberg LP, the parent of Bloomberg News, competes with LSEG in providing financial data. So there's the disclosure.
OK, coming up, what are we going to be talking about? The bond market sending a firm and clear message to the Fed chair. Talking tough on inflation last night. That was not enough. We're going to have more on the big moves, particularly at the long end of the bond curve. Plus, we're going to be talking about more on those big tech earnings that we've seen. Samsung overnight, Meta overnight, Microsoft overnight. We're looking forward to Amazon and Apple coming a little later today. Plus, we've got the CEO of Shell coming up next. We're going to focus there on what is happening in the Gulf. It is a very busy morning. You want to join the conversation? And we'd love to hear from you. IB Plus, BBTV Go on your Bloomberg. This is Bloomberg. Welcome back, 90 minutes past the hour. It is a massive morning for earnings on both sides of the Atlantic, actually. Let's talk about what is happening here in Europe, here in the UK. Shell is out with numbers, planning a new share buyback of $3 billion to be complete by the Q3 results. The adjusted profit coming through at $9.84 billion. Just to give you a sense of kind of where the market thought that was going to be, 8.68 was the estimate there. In terms of the adjusted EPS, 176 versus an estimate of 155. So these numbers are strong. Let's talk about why. The CEO of Shell is Wael Sawan, and he joins us now. Good morning. Thank you very much indeed for your time, as ever. Are these results extraordinary? I.e., are they normal? You've put a lot of hard work into getting to where we are now, but do you see the environment at the moment as being extraordinary rather than one that you can kind of extrapolate and use as a new benchmark?
I'd say there's three key factors. Definitely the macro around us is volatile. And then the two key factors that we can control. One is operational performance. Teams have been working really hard. This has been a focus area for us, Guy, relentless focus on operational performance improvement, and we're seeing that consistency playing through. But the second feature as well is we are a company built to be able to handle volatility. We have the world's leading trading and optimization capability. And what that allows us to do is to be able to unlock value during times of high volatility. But we're also built to be able to protect for the downside, given our downstream businesses, given our trading as well. And so really what we are trying to do is to be the name that allows a shareholder to be able to benefit from that upside volatility and to have the downside protection.
How much, therefore, of the kind of outperformance relative to expectations that I'm seeing this morning is down to volatility? How much of it is down to trading doing very well and really benefiting from the kind of volatility you describe?
Very difficult to apportion because you will not have the trading and optimization value without the length in the assets that we are currently have. So just to give you a flavor, in our refining business, we have had record utilization, 102%. We haven't seen that in over a decade. That meant that we can actually have the products, so the jet fuel, the diesel, the gasoline, to be able to indeed supply our customers at this point in the cycle. Our integrated gas business is on a high. Our LNG Canada venture, for example, is up to its 100th cargo and really achieved full capacity. Our Brazilian upstream business just hit a record this quarter. So all of that, in essence, underpins all of these opportunities to create value. And that's what we continue to do across our businesses.
Good morning to you, Wael. Can I ask you about the Qatar business and focus in on the Middle East for a moment? How long are you assuming that the Qatar business remains offline? What are your assumptions around Qatar at this point?
I wouldn't go into making assumptions simply because the situation is so fluid on the ground. And I was there just a couple of months ago to be able to meet with the team. Of course, we had some real challenges there. A missile hit one of our facilities. Thankfully, no one was hurt, and we are well on our way to repairing the damage that was incurred there. What I would say is at the moment we keep a very close eye on what's happening in the Straits, because at the end of the day the facilities are offline pending our ability to evacuate product, as of course is the majority of the oil and gas resources that are needing to traverse the Straits. And so no guesses on how long it's going to take, but suffice it to say we continue to focus on first and foremost the safety of our people and then finding alternative supplies to meet our customers' demands.
Well, is your willingness or enthusiasm for investment in the Middle East, is it being challenged at this point by what we've seen over the last 3 months?
The Middle East will always be a core region for energy. And when we look at any investments, we are, of course, always looking much, much longer term. So while, of course, the short-term disruptions are concerning and we need to be able to sort of grapple with what they mean at the right points in the cycle, longer term, we continue to have high confidence and look to continue to have a diversified portfolio of supplies. Of course, we saw the impact of us pulling out of Russia. If we had concentrated on one region or one country, it doesn't play to our model of being a global, diversified energy supplier and one that is able to optimize those supplies to meet our customers' demands. And therefore, I wouldn't rule it out or double down. I think at the moment, we continue to have that long-term view of fundamentals and we'll operate accordingly.
Well, can I just come back to something you said just a moment ago regarding refining? Record utilisation. Did you say 101%? Is there a cost further down the road? How long can you run your refineries at that kind of level? What happens with maintenance further down the road? Is there a price to be paid in terms of products further down the road that you think the global economy is going to have to pay?
Yeah, what I would say is 102% indeed what we were able to achieve is testament first and foremost to operational rigor and resilience. Of course, we continue to take the stoppages we need to be able to maintain the facilities, to turn around the facilities. That continues. But the beauty of the facilities, many of them have been with us for over a decade, is that we understand the operating envelope of those facilities. To the heart of your question, though, where are the challenges? The biggest challenge, of course, is the fact that as we err towards producing more jet fuel to meet that season of demand, it does mean that you are reducing gasoline and diesel production. And what we are finding at the moment is both gasoline and diesel are at decadal lows in terms of inventories, which starts to put pressure on those price lines. So we are responding to price signals in the market. And as a company, the biggest thing we can do is to make sure that we get as much production as we can, which is what we are focused on. And then secondly, to make sure that we are then leveraging that trading and supply capability to place those barrels where those price points are most attractive.
Wael, just very briefly, 20 seconds, has the messaging from the new UK government changed at all, given we have a new Prime Minister, to the sector?
Early days, of course, congratulations to Prime Minister Burnham for stepping up to the role. What I would say is at this moment in time, we are trying to continue to relay one core message, which is that we need to be able to have stability in the fiscal environment, stability in the investment environment. That is the biggest thing that any government can offer us anywhere in the world, and we continue to encourage this government and any other government to do that.
Wael, thank you very much for joining us. Really good to speak to you. Wael Sawan, the Shell CEO. Coming up on the programme, we'll get back to the central banking narrative. The Fed keeps rates steady, but investors signal their worries over Kevin Warsh's commitment to taming inflation. We'll focus on that long end of the curve once again. We'll speak to Kim Crawford, JP Morgan Asset Management. This is Bloomberg.
Thursday the 30th, good morning. 29 minutes to go until we start trading here in Europe, equity trading. Futures at the moment, you almost wonder whether we're at the point where there is so much going on that there's nothing to do. How do you price in all of this extraordinary news that we're seeing at the moment? The earnings story that we're talking about, what happened last night with the Fed, the story around what's going around AI and the earnings that we're seeing there. So much to fold in. Geopolitics is another factor. It goes on and on and on. Anyway, basically what Europe's doing this morning is nothing.
Not very much, with a whole lot of news. We are dealing with a slightly higher rates environment, aren't we? And that was the handover from the United States yesterday. Certainly the long end of the Treasury curve got a lot of attention as a result of what the market interpreted as not enough hawkishness coming through from the Fed, not enough action, perhaps. You know, do they still have the credibility when it comes to fighting inflation? So we saw those long end yields go higher. And how is that playing out into Europe? Well, it is pushing those yields higher in Europe as well. That's the 10-year you've got on your screen. I'm looking at the 30-year on my screen. We're up by about 5 basis points on the French, the German, the Italian. So we do see a bit of read across from the Fed into the European rates picture. Let's talk about that then some more. The US 30-year yield soared to its highest level since 2007 as investors question whether Chairman Kevin Warsh will deliver on his promise to tackle price pressures.
Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. I asked for a good family fight and I got one. I heard a lot of commonality on the questions. Were there different leans on the answers? You bet there was. In the high mountain air in Jackson, Wyoming, I'd like to also frame the big questions. There is a tendency, especially with the proliferation of meetings and press conferences, to get caught up in the myopic.
Well, let's not do that. Let's talk to Kim Crawford, Global Rates Portfolio Manager over at JP Morgan Asset Management. So we won't get caught in the myopic, but certainly the focus for markets yesterday was this big move in the long end of the curve. What did it signal to you then, Kim? Is this about a lack of credibility because there's a lot of talk but no action?
Yeah, I think, given core inflation is at 3.4%, at least the PCE measure is, I think it's a signal that it was too dovish a hold. We need a slightly more hawkish hold. So we saw earlier that, in theory, the resolve to maintain price stability is there, but there were a lot of dovish elements in the Q&A. So Warsh talked down the importance of the last soft inflation data print in this decision. He talked about needing time to understand underlying inflation and what's driving that. He even alluded to the possibility in the future of looking at AI-led inflation a little bit separately from the core. And then also now there's a question mark of whether PCE is going to be their actual inflation measure next year. And then just 2 more points as well. I think it was interesting that he talked about the markets having done some of the tightening, some of the work for the Fed.
Yeah.
Well,
so on that point, so not hawkish enough, but on that point, so it's interesting because you can either cut, and the dominant story this morning does seem to be lack of credibility. That's why the long end yields went higher. But yes, the Fed acknowledges that actually the market is doing the job for it to some degree, and so to some degree, they want to see higher rates, don't they? From all this hawkish language, maybe not at the 30-year, maybe they want to see it in a different part of the curve. But how do we sort of balance that narrative?
I don't think they would have wanted a twist steepening in the curve. So saying that we are going to stay on hold for longer than you expect, but then that increases inflation risk premium at the back end. Look, I think it's a question of understanding their reaction function as we go. It's the second meeting so far. For me, I still think that the disinflation progress could be enough by September to actually mean that the message seems a bit more coherent with the data that we're getting. And so if I think of a scale and what's on the inflationary side, the disinflationary side, we've got those AI-led pressures on the inflationary side. We've got some energy pass-through lingering shocks there into core goods. But then if you look into the second half of the year, you do get seasonality on your side. You do get a methodological change to PCE measurement. We are seeing in the rent factors and the healthcare factors that there are some weakening, some renormalization, and we do think that's there to stay. So I think if I were to look at the scales, I think it tips slightly in the balance of that disinflation picture coming through. Okay. But the margin for error is small.
I'm on the work page on the Bloomberg, the legendary function. It's just in the last couple of seconds tipped to being 70% probability of a rate hike in September.
Yeah. I think the inflation risk premium, the markets have to price that way, right? The risks to inflation are only to the upside. So you have to price closer to that hike than no hike. But we do have 2 rounds of labour market data, 2 rounds of inflation data by that meeting.
The data's important, but credibility is important as well. Mm-hmm. And the market's questioning, you could argue, credibility last night, into this morning. In order to get credibility back, regardless of the data, does the Fed have to hike at this point?
No, Not yet. And I think we're going to hear a lot more from the rest of the governors before the next meeting, and we'll see what their reaction functions are as well. I do think a bit of Warsh, what Warsh has maybe mentioned, is more, some of them lean more towards his views. And, we might hear a bit more, Waller has said as well that if inflation is too hot, we will need to hike. Williams has given us a pretty clear guardrail of what he needs to see for the rest of the year, which is 0.2% PCE, averaging for the rest of the year.
Yep.
So there is a bit of a credibility question mark, but I don't think we can throw everything out the bathwater yet.
Kim, what's the headline going to be out of the Bank of England? Are we going to be focused on the number of dissents? Are we going to focus on QT and new guidance around QT, or new analysis ready for a policy announcement in September? What's the focus for you?
So not as contentious a meeting as the Fed meeting, but a hawkish hold. It has to be hawkish. Inflation is still too high. The risks are to the upside, but the hold is pretty consensus. Inflation has come below the bank's forecast since the last meeting. There's nothing particularly worrying in the run rates of core goods or core services inflation. And at least for now, the bank's not seeing really that energy price effects spiraling into indirect and wage price settings yet. So staying on hold makes sense. The QT decision will be important too. We've always looked at that in terms of the technicals and the back end of the curve. But I think the direction of that is pretty clear from the bank as well.
Do you think the bank needs to get a greater understanding of what the fiscal picture looks like before it moves? Before it moves or after, it depends what the inflation data says before the next meeting as well. But the fiscal news definitely matters. How net stimulatory is it for the economy, and hence what the impact is on inflation. We expect the fiscal rules to still be held, as the government and the Chancellor have told us so far. So I don't see a big immediate boost to growth, and that's going to be inflationary and demand-led, which the bank will have to react to. But we still need to know what the revenue-raising measures are. We haven't gotten them yet. We expect we will. And so I think it will factor in, but they'll have to wait to see what the extent of the measures are before they can react to it. Busy morning, Kim. Thanks for stopping by to see us. Kim Crawford, Global Rates Portfolio Manager at JP Morgan Asset Management. And on a programming note, we've got it all covered for you. Got a special programme coming up on the Bank of England rate decision. We are going to kick things off at 12:30 p.m. today.
Yes, we will. So bring your lunch. Join us. Let us. I don't know why I suddenly thought about that. I'm not sure. Maybe I saw 12:30. And I
like
thought,
the idea.
I thought, when am I having lunch? Yeah, that's an important question. We'll sort that one out. Let's turn our attention to the markets in 3 minutes on the opening trade with Markets Live Executive Editor Mark Cardmore, who's probably ready for lunch where he is in Singapore. Mark, good morning to you. So let's talk about the press conference with Warsh at the Fed. I mean, you've been quite a fan of stepping away from forward guidance. We're supposed to pour more attention onto the data and less on the Fed meetings. What did you make of yesterday?
It was a disaster. Just absolutely terrible press conference. As you say, Anna, I'm all in favour of stepping away from forward guidance, returning to where it was 20 years ago, where people actually look at the data. I think we've become stupider over the last 20 years as we wait for Fed officials to translate data that we could have seen a week before. So I'm delighted that we stepped away from forward guidance. And I also think that Warsh had done a great job until yesterday, in terms of that he kind of sounded quite hawkish. As he said, he was letting the markets do his work. I have no particular quibble on the policy decision. Look, it's a very hard job, whether you hold or hike rates. You know what? It was in the balance either way, right? So I'm not going to quibble with any of that. My issue was with the press conference, where he basically undermined the Fed target, kind of saying that, the PC is the way they're measuring. Until January, he kind of implied they might have reassessed it then. He kind of talked about that's their one thing they're really targeting, but then talked about a bunch of measures. And then the kind of way he talked as if he was essentially new to the job and kind of working it out as if he was just going along. And, it would evolve over time. I have to say, it was an extremely disappointing press conference in terms of credibility. It is bad for the dollar. It's bad for long-end bonds. So we're going to continue to see steepness in the curve and weakness in the dollar until that credibility gets back on track.
Okay, so you basically got a signal you know what you're doing, and you're questioning that. Would a rate hike restore that credibility, signal that he knows what he's doing?
It might do. I think what's important is, if you're going to look, it's a very hard job. I'm not trying to say this is an easy job to do, but if you're going to step away from forward guidance, well, then don't say things that imply you kind of have no authority to do the job, no idea what's going on, you're kind of feeling your way around it, and that the inflation target may change, and kind of undermine both the committee and the targets and the measurement methods. So it's not specifically it's the policy, it's the impression you give. And I thought Warsh had done an incredible job up until yesterday, but because expectations were so high, people are actually very optimistic that this was going to be a sensible way to manage policy going forward. Everyone knew there'd be a transition period, the data is going to matter more, which means more cross-asset volatility in the short term as we adjust to that, but ultimately people thought this was going to be a good sign, and Warsh kind of conveyed it with authority until yesterday. So that's changed. So sure, if he's forced into a hike, does that really add to his authority? So if it's kind of seen as, this is a policy mistake, and now he's been backed into a hike he didn't want to do, that doesn't help. So I don't think it's whether it does a hike or not. I think it's the communication going forward. Look, if a politician talks a lot but says nothing, that's kind of admirable, but it doesn't kind of build his validation. It's the same for him. That's kind of crisis policy mode here. He should not imply he doesn't have a clue what's going on just because he doesn't want to say too much forward guidance. Yeah.
Jackson Hole's going to be interesting, isn't it? Mark, great stuff. Thank you very much indeed. Mark Cudmore, not mincing his words when it comes to the Fed. You can obviously follow all of the MLive team's view on what is happening here. There's a very simple way of doing it. MLIV Go is the function on your Bloomberg terminal. We're going to talk toothpaste next. Haleon sales rising more than expected on robust demand for Sensodyne. We will have a conversation with Brian McNamara, the CEO of this business. He's coming up. This is Bloomberg.
Welcome back. This is the opening trade. 15 minutes until the start of cash equity trading for European stocks, and the futures picture looks a little lackluster, really. Maybe not so on the French market, but the German market a little bit under pressure. We'll watch Adidas over in that market. That's one of the stocks could be on the move. We're watching Anglo-American. We're watching a whole host of corporates, some of which we're going to be talking to, CEOs we're going to be talking to during this programme. Guy, LSEG, Shell, Haleon.
Haleon. Let's talk about oral hygiene, shall we, for a moment? Just take a brief pause to talk about how sensitive your teeth are feeling. Haleon, out with numbers this morning. The top line's definitely moving. The margin line's definitely moving. Toothpaste continues to outperform and continues to do very well versus its rivals. We're talking Sensodyne here. We're also talking Panadol, painkillers, and various other products you probably find in your bathroom cabinet. Brian McNamara is the CEO of Haleon. He joins us around the table this morning. Revenue matches expectations, but looks pretty strong. The operating margins ticked up in the first half. 24.3 is the number, the estimate 23.6. Where is the strength coming that drives those kinds of numbers?
Yeah, thanks, Guy. 3.1% organic sales growth in the quarter, and that is a sequential improvement from Q1, which was 2.2%. U.S. has made good progress in the quarter and actually delivered that 3.1% growth, also underpinned by 2% volumes. Operating profit growth up 8.2%, and that was driven by our gross margin improvement of about 140 basis points. And that's linked to the productivity program we announced 2 years ago, which continues to deliver ahead of our expectations. Strong cash flow, so leverage is down to 2.5 times, and we reiterated guidance of 3 to 5% organic sales growth and high single-digit operating profit growth for the year. And you also mentioned star performer continues to be our oral health business, where oral health grew 7.2% in the first half.
Why has the US made this step change? I've read a lot this morning about sort of shelf adjustments, which I'm assuming is not a DIY term. So what is it that you've done in the States, self-help, that has allowed you to deliver?
Yeah, I think a few things. First, we made some changes in the U.S. and we announced a new operating model change in early January, and the U.S. was the first to go. So commercial execution, for one, which is the shelf changes. We've seen increase in distribution, increase in shelf placement across the portfolio. Second, I would say, is innovation. We've launched clinical repair, for instance, in the U.S., which is the third pillar of our clinical range, and the share growth on Sensodyne continues to really outperform in the market. And broader innovation, things like Centrum Agify, We have a Centrum specifically designed for GLP-1 users, Excedrin, rapid relief, some good wins across Voltaren in the portfolio. So really about execution and delivering great products to consumers at a time when they really need them.
Good morning, Brian. Yeah, being GLP-1 adjacent in some sense, it seems to be something of a theme this quarter for some corporates. Let me ask you about, so Sensodyne, the mindset you brought to Sensodyne, or the successes you've had there, is that something that you can learn from? And thinking about the over-the-counter drugs, the more pharmaceutical products, is there more room to improve things there?
So, yeah, first of all, on Sensodyne, it's been an amazing success story, and we are focused on what we call therapeutic oral health. So both Sensodyne and brands like Parodontax or Corsedil here in the UK are focused on things like gum health, sensitivity, and enamel health, providing real benefits for consumers. We do clinical studies, we develop products, and the dental recommendation drives 70% of the trial that we see in those categories. So there's huge opportunity, and that's a flywheel that keeps on delivering. If you look across our portfolio, we believe there is opportunities in areas like vitamins, minerals, and supplements to bring a more of that science base to those categories, and we've done some of that. We've had cognitive claims on Centrum Silver, for instance, and we've seen real good pickup from that kind of thing. And then across our OTC portfolio, the pharmacist recommendation really matters, and we have the largest pharmacy sales force in the world for OTC business, because we are the largest in the world, and we see really good opportunity there in that pharmacy recommendation.
On another subject, can I ask you about the impact of war in the Middle East, what that does to a business like yours? And I guess that's, in terms of sales in the region, probably small for a business like yours, but interesting to understand. And then maybe on the cost side as well.
Yeah, so on the cost side, like everyone, we're seeing obviously increases in oil costs. Now, we're probably less exposed than many other companies in that area, because we just have less exposure to petroleum-based kind of derivatives in our products, smaller packaging and things like that. And because we have productivity program that's going so well, we can absorb those costs, and we can move ahead and not need to necessarily take pricing to cover those costs. On the Middle East specifically, we do have a disproportionately large business in the Middle East. It's about 5% of our business, and we have really strong shares there. And we have seen an impact. So areas like Dubai and Pakistan, where we have really strong businesses, we've seen double-digit decline in the category. So our Middle East Africa segment was flat on the quarter, but we do expect that to improve despite the conflict continuing in the second half.
Is that fewer visitors? What's the driver?
Yeah, quite a bit in certainly in Dubai. That's it. Just the visitors are down.
When I think about your business, I think about a business that is stable. It is like, people talk about these kinds of businesses as being staples. How inelastic is demand? How price insensitive are consumers? What is the message you get on the consumer right now, particularly in the US? What are retailers telling you? Can you just give us a sort of macro backdrop to kind of your impression of the macro backdrop?
Yeah, so if I take a big step back and think about first the consumer in the U.S., no question the consumer in the U.S. is under a lot of pressure, and there's a lot of uncertainty if it's the Iran war, if it's oil prices, if it's potential inflation. Yeah. So there's no question you see a cautious consumer environment in the U.S. If you get then to the categories that we're in consumer health, listen, health really matters to consumers. And in health, brands really matter. And we have fantastic brands. And that's why I think we continue to see great growth in Sensodyne. And, in Q2, we've seen, really good growth in Centrum in the U.S. Brands like Benefiber and Tums grew double digit. So for me, we can't really impact how the consumer is feeling per se. What we can do is focus on our own execution, driving value for the consumer. Mm-hmm. So you would expect our categories to be a bit more resilient than others, but we're not immune to the consumer dynamic. So we're just focused on execution and delivering the value that consumers want.
Brian, thanks so much for joining us. Good to speak to you. Brian McNamara, the Haleon CEO. So we've talked about a lot of corporates this morning, a lot of earnings out. Alex Morgan has a rundown of the stocks we're watching.
Morning, Anna. Yeah, goodness me, what a busy day it is today. Let's kick off with Shell. We've had that second quarter profit beat from Shell. Year to date, up 21%. And this really is coming from the oil refining boom. One thing that is interesting, though, is there was that focus on Qatar. Shell is the world's largest LNG provider. There is still disruption there. So while, of course, there is a boon for the super majors from the disruption, there is also a pain point around refining in that region. Let's turn it over then to look at Airbus. We've had Airbus out this morning and a note of confidence that they will meet the deliveries this year. We also had Boeing's quarterly update yesterday as well. But you can see Airbus here in the orange, sort of, if you like, climbing ahead of where Boeing is right now. Turning it over to hear from Guillaume Fauré, the CEO, saying it's across Airbus's business that they're seeing positive noises. Of course, that is the commercial airliners, but also defence. I mean, it's a big focus in Europe. And then let's flip it over to L'Oreal, and here it's hair products. Volume, very important when it comes to hair products. They're really driving them. They're proving more resilient than compared to the US rival, Estee Lauder, for example. We're seeing here it's the focus on their hair care brands, and apparently a new trend of women wanting to wear their hair longer, helping to keep that profitability up. So an update from L'Oreal. We'll be keeping an eye on them as well. A really busy slate this morning of stocks to watch.
Alex, thank you very much. Hair care appears to be worth it. Adidas in focus as well. Maybe too soon to see the positives from the World Cup for Adidas, and we'll watch that one at the start of trade.
Right, there's all kinds of things going on. Keep an eye on the car sector, what is happening there. You've got some asset managers, Amundi's out, Sanofi's there with better than expected numbers. It's a busy morning. Those are the numbers you're seeing on the screen. This is Bloomberg. OK, we're getting to the point where the rubber meets the road. We're about to see how some of these earnings stories that we've been talking about this morning are priced in. That's one factor we need to fold into the opening trade here this morning. The other one is what happened last night with the Fed. We went out here in Europe. We finished down there. This is the move into the Fed. This is the move after the Fed. Big move in bond markets, but that was reflected as well in the pictures surrounding what the stock market did. So there's a lot going on, a lot to fold in. You've also got the oil factor to fold into the narrative as well, given what is happening in the Gulf. So that's the story. You've got an awful lot to think about, but in many ways, what you're not getting is a big reaction. Eurostoxx 50 futures are absolutely flat. The FTSE's down by 0.2%. The German market's a little bit weaker than that, down by around 0.4%. You don't necessarily get the volatility that you're getting in tech, maybe reflected in Europe, but there's so many corporates reporting this morning. It's going to be a bottom-up rather than a top-down market narrative, I suspect, Anna.
Yes, absolutely. So let's get to some of those bottom-up stories, shall we? And we'll start with the energy space, where we had numbers out of Shell. We spoke to the CEO, Wael, Sawan, a little bit earlier on. They've got a new buyback in the offing. Their adjusted profit for the second quarter came in well above expectations. So we will see where that one heads at the start of trade. We're also watching Adidas. They posted their numbers for the last 3 months through to June, and they came in a little lighter than expected. They missed estimates. There was a jump in World Cup marketing spend. So on the one hand, they might have seen some successes on the field, but there was this marketing spend dimension, the cost side, to think about. And so that seems to be taking the edge off optimism around that particular business this morning. We'll also watch the auto sector, lots of earnings out there. We'll also watch the banking sector, SocGen, BBVA, Erste, all improving their outlooks, and ING and Lloyds Banking Group beating estimates, Guy.
Yep, got a new 5-year plan from Lloyds. We'll talk to the CEO a little bit later on. Let's talk about the numbers right now and show you what is going on. The opening trade is here. Let's price in some of these earnings that we're getting out of Europe this morning and see what they deliver. FTSE 100, a little higher. I'm fascinated to see how Shell goes this morning, how Lloyds goes this morning. That, I think, is going to be a really interesting narrative. But there's also the kind of the macro top-down story on what is happening with iron ore and what is happening, obviously, with oil and gas. Stock 600 is down by circa 0.1%. These feel like very small moves at an index level. That is maybe going to be the narrative today. FTSE 100 maybe a little softer than anticipated. The CAC's flat, coming out of the gate, absolutely flat. The AEX is absolutely flat as well. The IBEX, I think you've got BBVA to price in there. It is down. The IBEX is down by 0.2%. And as ever, we're going to have to wait for the DAX, Anna.
Yeah, absolutely. Waiting for the DAX to open then, but we see a flat to negative picture then overall across these European equity markets, and a bit of outperformance coming through in the French market. So let's get to the sector breakdown and find out what is moving higher. To the upside, we have construction and materials, and that instantly takes us to France, because the top three in that space are Vinci, Bouygues and Eiffage. So some sizable French names moving higher, and so maybe that's adding some upside to the French market. So we're up by 5.3% on the Vinci share price, which is the best performer of all of those. Chemicals is also an area of resilience this morning. So despite the broad downdraft, we're seeing the chemicals sector not doing too badly. Not huge standout performers within that sector, but there is some movement on the upside. And basic resources also doing pretty well. We've got numbers from Anglo American this morning. We'll be talking to them about higher copper prices shortly. That stock is up by 0.9%. And more broadly, we see some positive performance across the sector with Rio, Antofagasta, both moving higher by more than 1%. So 5 sectors are in positive territory, Guy, despite the direction of travel, which is broadly weaker. And healthcare is the worst performing sector.
Yeah, that's fascinating, isn't it? Look at the upside, though. Schneider's the biggest points gain this morning. That's certainly helping out both the Paris market and the stock 600. Rolls-Royce is doing well. ASML's not having a bad night either, which is interesting given what we've seen from Samsung. But ASML's having a good morning, not a night. HSBC's up. Shell is up by circa 1%, but Rio's up as well. So the miners, some of the oil stocks and some of the tech stocks, adjacent tech stocks are doing well. But as you say, Roche, BAT, Sanofi, AstraZeneca, UCB, Novartis are the losers. I would say probably, it's the pharma space that looks like it's under pressure. It's Thursday, so I'm always slightly nervous about Thursdays, given the fact that we do see some ex-dividends. So I'm just going to go and check that as well. But Adidas has just opened, to your point. It's down by 15%.
Yeah, so a big, brutal move on that particular marketing spend from Adidas. Let's broaden the lens and talk about these markets then with Claudia Pansari, who's France CIO over at UBS Wealth Management. Claudia, nice to speak to you this morning. Let's talk about European earnings, shall we? We've had so many of them to deal with. Net, they add up to not a lot of movement this morning for European stocks. How optimistic were you going into the earnings season, and how intact are positive expectations for European earnings?
Hi, good morning, Anna. Thank you for having me today. Very positive, I have to say. We are great European stocks a few weeks ago, and we also great the banking sector, and we see that results are pretty good. I think people have been focused since the beginning of the year on AI and tech in US and then across emerging markets. And reality is that the economy is not doing so badly in Europe. We had French GDP figures this morning, results from some consumer names, but also results from the banking sector. And clearly we see some upgrades coming for a segment which was not loved until a few days ago, when we had this turnaround in the tech name, and when Europe is now outperforming, which is pretty good and in line with our expectation.
Okay, and so what is standing out to you, Claudia, as being new information in this earnings season? What do we take away from the earnings stories? I mean, is there a story of resilience around higher energy prices? Because as that concern lingers in markets, with the Brent price over $92 a barrel, we maybe need that narrative.
I mean, there are a few elements. The resilience to energy price, the resilience to higher bond yield, a turnaround on the margin. Margin has been under pressure in the European market for a long period of time, and now we see a turnaround. I will also say there is a recovery in manufacturing. We have seen PMI data improving quite a lot. Improving especially in manufacturing, where the data has been under pressure over the last few years. So the resilience is there. Probably there was a bit also the negative feeling about the capacity for Europe to rebound in terms of earnings, with energy price around $90 a barrel, and then with also the bond yield being at very high levels since the beginning of the conflict in the Middle East. And now we see there are surprises on the upside. There are upward revision in terms of earnings for 2026. We will probably also see revision in 2027. We are ahead of consensus in terms of expectation. We are expecting more than 20% EPS growth between 2026 cumulative, between 2026 and 2027. So clear there is a sort of catch-up. And investors have been, once again, focusing quite a lot on our market and essentially on IT. So now the surprise is coming from sector where investors are not positioned yet.
OK, so is Europe the anti-AI trade?
There is a small portion of Europe in AI. You have only a few stocks. The AI trade is mainly in US and in Asia. So this was the reason why we saw the stocks performing so well, and also some markets like Korea and Taiwan, which are really concentrated on few names and mostly on semiconductor. You have some stocks in Europe, but it's not the big part of the market cap of the European index.
When do higher bond yields start to become a problem?
I think already this morning, because you see the earnings are quite good and the market is slightly down. I think the message out of the Fed yesterday is driving up this bond yield in US and by correlation in Europe. The problem of the high yield is also linked to the fact that there is less space in terms of government of increased spending if there is a slowdown. So I think we are already at a level of yield which may start to impact the equity market. Unfortunately, I mean, there are few elements which are driving up this yield. One is inflation expectation. And after yesterday Fed comments, inflation expectations are up this morning. Then there is still this energy price, which remain very volatile. And then there is a premium, which is quite high on the long end of the yield curve, which is due to the level of debt we have in Europe. But I think we need to be very careful about this moment. On Europe, but also in the US, we have yield which are at all-time high since 2011. Probably this morning we are getting close to 4% for France, which also means the cost of debt is getting more expensive, which also add a risk on the long part of the yield curve. So I think we need to be very careful. But I also believe that the current level of yield is really attractive, especially for corporate or for sovereign, where the quality is there. So we should take profit of this level of yield if we believe, like we believe, that the yield will come down in the month to come.
OK, well, we'll see if that happens. For the moment, the story has been about higher long-end yields then, Claudia. What do you think that does to the US tech landscape if we see persistently higher yields at the longer end?
I mean, it's quite interesting because the landscape in US for now is mainly be driven by the performance in semiconductor, with CapEx spending. CapEx spending has been one of the major drivers of growth since the beginning of the year, both in terms of economic growth and GDP growth. If yield move higher, but this movement is low, I think equity can be resilient because the earnings side is still positive. The probably is about the velocity of increase in the yield. If we have a sharp rise in yield, of course, that will be damaging the equity market. But once again, there are two elements, the earnings and growth, and on the other part of the yield. If we have a rise in expectation and revision on the earnings side, I think US market can still be very resilient. The yield at one point will have some impact, probably on growth. And the moment will be, I will say, in two stages. Probably firstly up, and then with some data declining, job market to be impacted, we will have a second stage, we feel down. And then we will have also more support coming from the bond market. But for the time being, the bond market is really probably the main risk for this run on US, but also for the rest of the world.
Claudia, thanks so much. Thank you very much for joining us. Claudia Pansari, the France CIO for UBS Wealth Management. Let's pivot to another corporate earnings story this morning. The mining giant Anglo American has reported a profit increase and raised its dividend, joining the competition to cash in on record copper prices. The company is nearing the end of a transformation plan that will see it shift from diamonds, coal and platinum to focus on copper. Let's bring in the CEO of Anglo American, Duncan Wanblad, who's with us this morning. Welcome to the programme once again, Duncan. Thank you very much for being with us. How much of the strength in the performance that you're reporting today, how much is that very much a read across from a higher copper price? How much is it other things?
Well, look, it's certainly been bolstered by higher copper price, and certainly that's been augmented a little bit by higher prices associated with the minor metals, particularly those like molybdenum and silver that come with the copper complex. However, the underlying performance in the business is really, really good. Solid performance against the plans, bang on guidance in terms of the outturn of the business, and a pretty laser-like focus on the costs. Of course, we're in a world where seeing loads of inflation driven by all sorts of factors, and really thrilled with the work that the guys have done in terms of keeping costs under control. So I think it's a good balance of both, but fundamentally underpinned by good operating performance.
Okay, and sticking with the copper theme, Duncan, when do you think that we will see completion of your expected merger with Teck? Because that is very much about copper. And where do the synergies come from in that deal? Is it all about two plants in Chile and bringing those more cost effectively together?
Yeah, sure. So look, as far as the completion mechanics are concerned, we're just now waiting for approvals from China. And our expectation is that we should see these come through somewhere between September of this year and March of next. And as far as the synergies are concerned, well, of course, there is the large proportion of revenue synergies that we would see coming from the combination of Collahuasi and Quebrada Blanca. But actually, there's also a number of other synergies which result as a consequence of putting the two companies together. So we have some SG&A synergies, we have some marketing synergies of the combined business that will come through, and then, of course, a large proportion of procurement synergies as a result of putting this together. So we're well on in terms of setting up the integration process. We've got a team working together, trying to get this all sorted out so that we're absolutely good to go on day one, whenever that occurs, somewhere between September of this year and March of next, and really getting ourselves in the greatest position we can to accelerate the delivery of those synergies.
Duncan, good morning. Can you update me on the sale process surrounding De Beers?
Yeah, sure. Look, I mean, this has been a very long process, a process that's been characterized by many sort of complications, particularly those associated with the state of the diamond markets over the last few years. But despite all of that, we've really made great progress, and we are now pretty close to the end of that. And having said that, of course, this is exactly the time in the process where things are very delicate. So a number of parties have to all get together, have to all agree and ultimately sign on the dotted line. But looking good for getting it done, ideally somewhere between now and the end of this year.
Okay, we're reporting that you are in talks to sell the business to a consortium led by Gareth Penny for around $1 billion. Is that what we're talking about here?
Well, we're not exclusive with anybody yet, and what I'm doing is busy working with all the parties to optimize, the outcome, and I'm certainly not going to be drawn on talking about any of the specifics associated with any of those parties at this stage.
That valuation would be significantly below where I think the market had priced the business. How close is that number? Are shareholders going to be disappointed by the valuation, do you think, that ultimately you have to apply to this business? How are you communicating that to them at the moment?
Look, this is a competitive process, and the number will be what it needs to be when it comes out of this thing. I'm not suggesting I'm not suggesting anything about the specifics of that number. As I say, we are working through that with the potential buyers at this particular point in time. And I think what we can be certain of is that this will be a very realistic valuation of the business going forward.
Okay, Duncan, can I ask about the costs? You talked about the inflation challenges. You're pleased with what the team is doing to keep those under control. But I'm thinking about the impact of the war in Iran, the events in the Middle East, what that does to the business, and what self-help measures you can take to bring down the negative effects of that.
Yeah, sure. Look, I mean, certainly in and around the Middle East, we are impacted by two things really. One is the general inflation that creates on a global level, but of course, some of our iron ore product goes through the Straits of Hormuz to Bahrain, and so we've had to reroute some of that material as a result of the war in the Middle East at the moment. But I think fundamentally it's really all about staying on top of cost control, and this is a muscle that Anglo-American has certainly developed over the last few years, and I think is absolutely paying dividends. Getting on top of this more rapidly than many others might be able to do was sort of the secret of success in the first half of this year. It's not over. I think we've still got more work to do, and to stay on top of it. But as I say, a good muscle developed to get that managed. The iron ore markets, have enough diversity for us to be able to move stuff outside of the Middle East for the time being.
Duncan, we've talked in the past about the impact of electrification and the energy transition on some of the metals that you mine and increasing demand for those. On top of that, do you see increased demand from the wave of data centres that are being set up, or is it all just part of one big trend for you?
Well, look, I mean, it's all part of the same trend. The use of copper has now many applications, and data centers is absolutely one of those. The rate at which these are being built, I think, will augment the short-term demand for copper, and certainly is very positive for copper demand at the moment. So it is part of the underlying thesis for copper, without a doubt, AI data centers, but so is the re-electrification of the world. I think that also will continue to play a very important underpin to the copper story. And then, of course, we don't talk about this as much as we used to anymore, but it is very important to think about the role that copper plays in the improvement of people's lives generally. So I think that there's still, a fantastic underpin from that. So the fundamental drivers of copper and copper growth are very robust.
Duncan, one final quick question from me on, just can I come back to iron ore? Do you think, when does China bounce back on construction? What are you assuming? Are you assuming that current levels are here to stay for a while? What is your expectation in terms of how that picture turns? It's been difficult for a while. Is it bottoming out right now? What assumptions are you making?
Yeah, look, I mean, we're not expecting a significant turnaround in the current state in the short run. Our view is sort of more medium to long run. And again, it's very much underpinned by the role that steel plays in the development of societies. Without a doubt, the intensity of use in the developing world of steel is so much significantly lower than that of the developed world today, that it will absolutely continue. But there is absolutely now a bit of a surplus in steel making in China, and that will need to wash itself through in the next few years. Despite that, the businesses that we have a very unique offering to the market in the context of the type of iron ore that it produces. We're relatively niche and small in that context, and so we're forecasting that we should be able to ride through this period very well with those two businesses.
Duncan, thank you very much indeed for your time this morning. We really appreciate it. We'll look forward to the update on De Beers very shortly. Anglo-American's CEO, Duncan Wanblad. What are we going to be talking about next? More earnings. The conversation will switch firmly to what is happening here in the UK. Lloyds Banking out with a 5-year plan. The group's CEO is Charlie Nunn. He is next. This is Bloomberg.
Of course, with the Middle East crisis, energy costs are rising, same on transport. So we try to be very responsible. And we had also, in some cases, to price up to our customer to make sure we are able to continue to deliver great profit and great return for our investors.
Definitely the macro around us is volatile. So really what we are trying to do is to be the name that allows a shareholder to be able to benefit from that upside volatility and to have the downside protection.
This is the strongest performance that we have had since the acquisition of Refinitiv 5 years ago. We continue to improve our margin. We're getting great operating leverage out of the business. We do have a lot of confidence in the second half.
We're probably less exposed than many other companies in that area because we just have less exposure to petroleum-based kind of derivatives in our products, smaller packaging. We have seen an impact. So areas like Dubai and Pakistan, where we have really strong businesses, we've seen double-digit decline in the category. So our Middle East Africa segment was flat on the quarter, but we do expect that to improve despite the conflict continuing.
It has been a busy morning so far. Some of the CEOs we've been talking to just today on what they see in terms of their businesses and what it's telling us about what the wider market picture looks like. It's been a busy morning. Let's take a look quickly at the core six just to give you a kind of reset on what we're getting there. And as you can see, it's a game of two halves. On the right-hand side, ASML, Schneider and Nestle all rising and rising quite nicely. Schneider in particular is the standout story. But you've got Novo down. The pharma space is under pressure this morning. LVMH is under a little bit of pressure as well. Defence is certainly being rotated out of too, so that's interesting. What else are we watching? Let's turn to footwear. Alex, over to you.
Footwear and footballs, Guy. At this World Cup, Adidas sold 4 times as many jerseys and twice as many balls as the last World Cup. And this morning, they are down as much as 17%. And the clue in there might be this $212 million spend on marketing around the World Cup, weighing on what is otherwise a very good second quarter for Adidas. This morning, out of the gate, down around 17%. A really significant drop there. Let's flip it over and look at Rolls-Royce. Well, they've lifted their outlook this morning. They're in the green, up around 4%. Turning to Campari, the spirit maker. Good numbers there this morning. They're in the green. Obviously, they're the makers of Aperol, Campari, among others, up around 3%. And then turning to Magnum. Now, Magnum was spun out of Unilever at the end of last year. They sort of have got the Walls brand, Carte d'Or, and of course the Magnum ice cream brand. You'd think with the heat waves and beating estimates this morning that they might be up. There's actually down this morning around 3%. Something more to dig into there. Have a look through those full figures. But Magnum ice creams there are down around 3% this morning. Those are some of the names on the move, but really it is Adidas that's got a sharp drop this morning after that big World Cup marketing spend.
Alex, thanks very much. Alex Morgan with those stocks that are moving. And that Adidas story is quite fascinating, isn't it? I mean, all those very expensive footballers they paid to be in that commercial, you know, maybe that adds to the marketing spend. So watching that, we're also watching Stellantis. The numbers there didn't look bad, but the stock under pressure.
Airbus sounded quite positive. Its stock's down by 2%. It's had a good run into the numbers. The pharma space is under pressure more broadly. I'm trying to figure out kind of what do the rotations look like this morning in terms of what the market is signalling. Schneider, in terms of point story, Schneider, Rolls-Royce, ASML, Shell, BBVA are the big winners. And are lifting markets this morning.
They are. And when we come back, we'll dip into the banking sector. A conversation with the Lloyds Banking Group CEO, Charlie Nunn, will be with us next. This is Bloomberg. This is the opening trade, 30 minutes into a really busy session when it comes to corporate earnings then here in Europe. And broadly speaking, we've done quite positively with that earnings story this morning. European equity markets are on the front foot. But this perhaps over on the DAX in Germany represents the World Cup Adidas story you didn't think you would hear about this morning. They have been upgrading expectations of the top line and what they do on revenue as a result of their successes at the World Cup. But it does seem to be that marketing spend number that's weighing on the business, and that's taken a real hit. So the underperformance of the DAX, it isn't all Adidas, but that certainly adds up to a big headwind for them. In the meantime, the CAC 40 moves higher, up by 0.6%. Construction to the upside. Guy, what do you see?
Absolutely. In some ways, Europe isn't moving a lot, considering the volume of information that it's being delivered with this morning. And the reason for that's fairly straightforward. 345 stocks are up, but 234 are down. So basically, you've got a market that's slightly on the front foot, but not by much in terms of the balance. Volume picture, though, tells you a lot. This is a very busy market this morning. There is a lot to price in. There is a lot going on, both from a kind of macro story, but from a kind of bottom-up single stock narrative story as well. So let's deal with the latter of those two factors. Schneider out with numbers. Remember, this is a company that highly exposed to the data center build-out. It is up by 5.33%. Airport de Paris is up by 11.41%. I suspect a lot of this may be down to the fact that what we are seeing here is actually a read across from the Gulf. You take out the big hubs like Dubai and Doha. I don't mean take them out. I mean kind of you reduce their capacity. And what you see, therefore, is maybe a benefit coming through from some of the European airports. And maybe that's a benefit that we're seeing being reflected in the numbers coming through this morning. So there's a readjustment maybe as a result of what is happening with the Iran war. Vansi, you mentioned it, big driver of the Paris market this morning in the infrastructure space, up by nearly 5%. So some really interesting stories on the upside. Adidas is the obvious one on the downside. This is a cost story. It is certainly impacting the business, and the market is marking it down quite sharply, 70% now. Stellantis is down by 4.71%. It's a busy morning for European autos. Look at names like BMW, Renault also out with there as well. And a big disappointing set of numbers coming through from Rentokil this morning. That stock in London down by 16%. So there's really big moves on either side, but in some ways, Anna, they're just balancing each other out.
Yeah, that's the market story then, Guy, this morning. Let's get to some of the other news flow that we are following. The US launched a new wave of strikes against Iran. The strikes came after a surprise assault by Iran on an American military base in Jordan, which intercepted multiple ballistic missiles and sent oil prices soaring. Meanwhile, in Egypt, fires broke out aboard two liquefied natural gas vessels at the port of Damietta in what appeared to be the first attack on that country's territory since the war began. Over in Poland, Poland says it's investigating an unidentified object that crashed near its border with Ukraine. Air defense radars tracked the object over Polish airspace before it came down near a village about 100 kilometers from the border. The military says the incident happened as Russian long-range aircraft launched missiles over western Ukraine. And 30-year government bonds in Australia, New Zealand and Japan came under pressure after similar-dated US yields jumped following the Fed's decision to leave interest rates unchanged for a seventh month. The Fed chair, Warsh, insisted the decision was not a sign of inertia at the central bank, which he reiterated is committed to tackling inflation. Bond traders have lowered expectations the Fed will raise interest rates at its next meeting. Guy.
OK, let's talk about some of the corporate news that we are watching and continue to watch. Second quarter earnings from Lloyds Banking Group this morning have beaten estimates. Pre-tax profit rising 14% from a year ago. Britain's biggest lender also unveiled a 5-year plan taking us to 2030 to boost non-interest income, basically diversify away, make the business less susceptible to that interest rate story. The stock is up by 0.4% this morning. Which actually, in some ways, a little bit of a surprise. Maybe it's the guidance that seems to be the factor here. Let's find out. The Lloyds Banking Group CEO is Charlie Nunn and joins us now. Charlie, you've unveiled what appears to be a fairly good set of numbers. You've got a 5-year plan that looks ambitious. The stock is only up. The stock is up by 0.5% now. See, that's an underreaction. Would you have expected more? This is an exciting picture you're painting here, isn't it?
Yeah, look, as I said, announced two things today. First of all, a strong set of Q2 results, but that's really the end of our 5-year strategy. And that strategy, we've got the group back to growth. We've been winning market share. And we've actually had really strong support from our shareholders, and they've seen the story and realised the transformation that we've been leading. And then the second thing is laying out our new strategy for 2030. We're calling it Accelerate 2030. And that's about raising our ambition on how we make every one of our customers get a simpler, smarter, more connected experience right across our retail, commercial, insurance and wealth businesses. And we're going to be investing £3 billion a year over that 4-year period. And we've got some exciting growth to do what you said, continue to grow at mid-single digits, continue to diversify the revenue streams and deliver very strong shareholder returns. And there's some exciting things coming. I'll give you some teasers, but a new smart wallet, Lloyds Smart Wallet being launched today, the first integrated transport ecosystem being launched. We think we can get 1 million new people saving with our AI tools, and we're going to be the most rewarding bank in the UK. So lots to come.
Lots to come. In the near term, and I'm just reading a series of analyst notes that are beginning to pop into my inbox this morning, about what you've done. The sense seems to be that you're being slightly conservative on guidance. Are you being slightly conservative on guidance, Charlie? Is that your feeling this morning?
Look, there's two parts to our revenue guidance, which is obviously the important part of our story alongside our cost discipline. One is mid-single-digit revenue growth. We're committing to a decade now, given what we've delivered now for the last 5 years, of mid-single-digit growth based on Lloyds Banking Group. That's a really strong story, given who we are and in terms of how we're delivering value for our shareholders. Within that revenue growth, we're committing to another 8% CAGR per year of other operating income. Those are those businesses we've been growing, investing, winning market share, like transport, like wealth, like our Lloyds Living proposition, and we can see that's a pretty ambitious plan. The second part is our big balance sheet-based businesses, which is, we've grown successfully. And as you'd expect from Lloyds, we always give sensible and prudent assumptions to underpin those businesses. But we don't make assumptions around the yield curve or competitive pricing that would put our forecasts at risk. So that's available for our shareholders and our investors to make the choices they want around those things. But we've given good growth on net interest income, ambitious growth on other operating income. And we're really excited that we can look to a decade of that kind of value creation for our shareholders. The one other thing we've announced today is a step up in our dividend by 30%. And another £1 billion buyback at the interim. It's the first interim buyback we've done. And that's really because of the board's view that we have really de-risked the business and we have very sustainable returns going forward. So we think it's a good story for our investors, an even better story for our customers.
Charlie, good morning. So you've announced and you've given us some highlights of your new strategy this morning, which is interesting to hear about. How does wealth fit into that strategy and what is it dependent on? Is that a sort of macro growth dependent ambition that you have around wealth in the UK?
So actually we have some really sustainable long-term wealth businesses and then we have some new ones that are going to be evolving. So we have the second biggest workplace pensions business in the UK, and that's a very stable, mature business. It's obviously hugely important in terms of building broader financial stability for our customers in the long term. That's been growing well and will continue to grow that business. But we also have a self-directed wealth business, a full advice business, and this year we've been the first to market with a new AI invest agent that can start to bring investment advice to the whole of the population, to all of our 28 million customers. Now that's really exciting. It's the first time that's been launched anywhere, and later this year under the new regulatory regime called targeted support, we'll be allowing that to talk to all of our 28 million customers and bring investment advice to the whole of the UK. And that was our promise I kind of teased you with around we think we can get 1 million new investors into investing. And that's going to be brilliant for driving better outcomes for our customers and a broader distribution of our direct-to-consumer and advised wealth propositions.
Okay, so that's really interesting. This saving AI tool that you were talking about at the start. So interesting that what that is able to do. How do you evaluate your spending on AI? Everybody in this sector is rushing to spend a lot of money to try and capture the benefits of AI, Charlie, but they're not for free. What is the return on investment on AI spending? What does it look like right now?
Yeah, so look, it's early days in AI is our view, and we're right at the forefront, certainly within the UK, of applying financial services for customers. This year, for example, we have announced that we're delivering £100 million of benefits in year, not multi-year, in year, from the application of just generative AI and agentic AI. Obviously, AI is a much broader set of benefit for customers in the business going forward. When we look at it, we think it's a really important part of the next few years, along with digital assets, which is going to be very important, not just stable coins, but digital assets, especially for our corporate and institutional clients. And we see it very two-sided. At least 50% of our investments are going into differentiation and revenue growth, things like the coaching and investment and advice tools that we just talked about. And then 50% of our investment is going into enabling our organization to do more efficiently, scale more efficiently, and be better around things like fraud and risk management. So we see strong returns today, and it's absolutely part of our plan to be right at the forefront of that for our customers in the context of our business.
Charlie, when we came into this conversation, the stock was up 0.4. It's now up by 1.4. So you're obviously saying the right thing right now in terms of how the market is reacting to what it is hearing. So that's great news. Can we just wrap it up with a quick take on what is happening in the UK and what you see in terms of the macro picture here? Your assessment thus far of the new government and what it's going to try and do and what that means to the banking sector and what you think it means for your customers, the consumer.
Yeah, so look, the economy has been quite resilient and consistent now for a while. Clearly, there's a lot of uncertainty. There's some issues around inflation for households and businesses. But when you look at the data underpinning that, it's a very resilient economy. People are being very adaptable, but it's a slower growth out forecast. When we've laid out our forecast for the next 4 years, we're seeing GDP growth, real GDP growth of about 1 to 2%. Unemployment increasing a little bit, but then coming down, so pretty stable in that context. And rates we see coming down only one more time, actually probably next year, from 3.75% to about 3.5%. So that's the kind of outlook that we have. Underlying that, households and businesses are actually at their most resilient level that they've been for a very long time, for probably since the financial crisis. You know, indebtedness levels of households and businesses have fallen 20 to 30% in the last 5 years. So there is the capacity to move to a higher level, but not the confidence today. And then from the government, look, it's early days, but the government's commitment to growth, to reform at all levels, but including regulatory reform for our industry, driving place-based growth and economics at a community level, focus on housing, infrastructure. These things we think will benefit us communities, will be good for the UK, and obviously are very aligned with Lloyds Banking Group's purpose and how we support customers.
Charlie, thanks very much. Thanks for joining us, the Lloyds Banking Group CEO, Charlie Nunn. Coming up on the programme, oil prices swing as the US wraps up a fresh wave of strikes against Iran that focused on military targets. More on that next. This is Bloomberg.
Morning, how you doing? 45 minutes into the session and maybe a time for a pause, maybe a kind of catching of breath to assess what the situation looks like. A little bit more positive, I would argue, maybe to what we had anticipated first thing this morning. There are some outliers, certainly Germany is one of them, and the Adidas story I think is interesting this morning, but there's also the auto trade to fold into that story. But generally European equities are on the front foot. US futures are actually also on the front foot after being battered yesterday by, well, a bunch of things. Tech was one of the factors, and also the Fed. Plus we've also got higher oil prices to fold in.
We do have higher oil prices. Brent crude up by 1.5%, now trading above $90 a barrel after the US carried out a fresh wave of strikes against Iran that focused on military targets while stopping short of hitting bridges and power plants. Let's get an update then from Bloomberg's Abir Abu Omar. Talk us through the latest on these strikes, Abir. For a number of days it seemed we'd stepped away from the tit-for-tat format, but we seem to be back to that this week.
Good morning, Anna. Yes, we're back to that is what is seemingly happening on the ground. Perhaps I start with the latest. From moments ago, we heard that in Kuwait, a Chinese company was hit, killing one worker there. That is the latest, again, just moments ago, that happening. And that follows what was described as a heavy wave of strikes by the United States Central Command against targets in Iran, as you have suggested. Those seem to be a little bit more measured strikes because we're not seeing attacks against civilian infrastructure, bridges. We're seeing mainly military targets being hit in Iran. But nonetheless, tit-for-tat attacks are back in the region. That ceasefire that was signed in June in Switzerland seems to be out of the window for the time being. Neither side is coming back to the negotiation table actively to discuss those concessions that were mentioned in the MOU that was signed, those 14 concessions, Anna. And meanwhile, we're also monitoring the traffic, or the lack thereof, in the Strait of Hormuz. We did report that a Qatar LNG ship was able to make its way through the Strait of Hormuz. It was idling around the waterway for about 3 weeks, but it was able to make its way through with its lights on. So we're seeing some movement in the Strait of Hormuz, but nothing compared to pre-war, and especially over the past couple of weeks or so, we're seeing a movement slow down significantly. We're also keeping an eye out on the Red Sea. Bab el-Mandab, the strait there, is also at risk of Houthis in Yemen attacking it. So really what could be dangerous here is new fronts opening up in this war. That is what we're keeping keeping an eye out on, as well as that Brent crude price now, as you've mentioned, above $90 on the barrel.
Abir, thanks very much. Bloomberg's Abir Abu Omar. Let's take a look at some of the other events we're watching out for today. We'll keep an eye on that oil price, 92.27, up by 1.7%. In terms of data, then, we get Euro area GDP at 10 a.m. UK time, the Bank of England rate decision, which we will be across as a team shortly. 1 o'clock UK time, we get German CPI, we get US GDP, core PCE, jobless claims. That's the sort of data deluge that we get from the States later on. And there's a lot of earnings news to get excited about from the tech sector. Over in the United States and here in Europe, we've got other earnings stories to cover as we, I was going to say round out the week, but we're not quite there yet, are we, Guy?
We're definitely not done yet. And join us for lunch for that Bank of England decision. We're looking forward to it. OK, let's talk about tech. Before the bell, before we get to those results from Apple and Amazon that we've just been talking about, we've also got to factor in what we've basically learned overnight. We've got Microsoft surging in late trade, continuing strength in its cloud computing story, Meta. Meta had a tough night, slumping after disappointing revenue forecasts and that ballooning AI spend that everybody's now questioning. Bloomberg senior strategist Neil Campling joining us to talk about all of this. What stands out?
Yeah, I think what's interesting is that we have contrasting fortunes here in that Microsoft has delivered 43% Azure cloud growth.
Yep.
So such stunning growth is, if you like, justifying the big AI investment spend on their own AI network. So that's kind of paying off. Whereas, I think in simple terms, Meta hasn't got the same kind of growth forecasts and a confusing kind of outlook in terms of what they're actually going to be building this AI compute power for. In simple terms, Microsoft revenues are $90 billion for a quarter. Meta's are $60 billion for a quarter. But in CapEx terms, Microsoft's only spending $10 billion more than Meta is. So you've got that as in Microsoft's OPEX grew 10% year on year in the quarter. Meta's operating expenses grew 65% year on year in the quarter. I mean, it's a substantial difference. Microsoft generating nearly $20 billion of free cash flow in the quarter, whereas Meta's almost disappeared completely, down 80% year on year to around about a billion, depending on which measure you use. So they are contrasting fortunes here.
So that's the contrasting story there. And how does Samsung fit into all of this? Because we've got numbers out overnight. If you look at the bit of the business that contains smartphones, that's not doing that well. But actually, that's not a very big part of the business anymore.
It's not at the moment. And actually, if you listen to the conference call, they were talking about they actually saw consumers trading up to the higher end smartphones within that division. But then we look at Qualcomm and ARM earnings, which were both impacted by lower volumes in that division. Now, the upside was all in the memory side. That's going to be of no surprise to anyone. The one caution I'd have there is that we now have 4 memory-related companies with 80% plus gross margins. And historically, that's unsustainable. And, of course, they and Micron and Hynix are all ramping CapEx massively, and that's going to be an impact for margins going forward, I would suggest. And also, of course, that's going to lead to lower DRAM pricing eventually, and we're already seeing the prices of AI tokens coming down significantly in the last two months.
Amazon, Apple?
Amazon and Apple, the focus on Amazon's clearly going to be on CapEx again, plus what they'll do with the AWS growth. Can they do what Azure's just done? And Apple really is all about the cash flow. Yeah. And I think probably really good free cash flow generation, unlike...
It's going to be extraordinary.
Well, Apple, I think, are just sitting there to wait to see which AI model wins out.
Yeah.
And then they can sign a deal like they've done before with Google on search. So don't need to invest in the AI. They'll just rent it.
Yes. Neil, thank you very much indeed. Neil Campling on what we're seeing in tech. Tech's not the only story. You've also got a Fed to fold in, plus a series of earnings. Let's talk about some of those narratives that we need to talk about this morning. Skylar Montgomery-Koenig is here. Fed.
Yes.
So the market didn't like it?
No, not at all. I think it's almost like the market now wants to bully the Fed into hiking in September in terms of there's this worry around are they actually having credibility around inflation fighting? You have inflation on a PCE basis that's 2 times target. And there was an expectation there would be some kind of policy move or at least kind of firmer footing around that hawkish guidance. And there was no guidance. So the market's saying, you want us to tighten policy for you? We'll do it. Yeah, exactly.
And I mean, thought we might see more of an impact. I guess we are seeing an impact of the Treasury story onto European government bonds, in that we are seeing the same directional move. We're seeing yields at the short end come down, and we're seeing yields at the longer end go up. Not by a huge amount, but there is some read across then into Europe.
Yeah, absolutely. And it seems kind of unfair, right, in terms of the ECB has hiked. Inflation is definitely not as big of a problem there, particularly when you think about persistence in terms of the demand side. And if you look at government bond correlations, they're very, very high to the US just generally. It's kind of 0.8 across the board for G10. And it makes sense, right? The US is the risk-free rate. It has the benefit of being the world's reserve currency, big, deep liquid markets. And so when yields in the US rise, you get demand for higher compensation elsewhere. And then I think the other important thing to remember is that, yes, it's the US inflation fighting credibility that's under speculation, but it reminds investors generally that we have more macro shocks, that term premiums should be higher, that yes, yields are the highest in many places that they've been in more than a decade, but we had an unusual last decade.
They're not the only central bank hawkishly holding, talking hawkishly but not actually doing anything.
Bank of England?
Yes. I mean, the Bank of England, the bias, again, I think is probably higher yields. Nothing's expected from this meeting, but it's what the pricing is telling you in terms of a full hike isn't priced till November. Now, there's no reason for them to push back against that because you don't know what's going to happen with US-Iran. And the key thing for the UK is that July inflation data, and that we know it'll be higher because the UK is quite unusual in terms of it does these price resets on bills. Utility bills in general, often gas sets that price. That gas price is still very, very high. So we know inflation in July will be higher, and you're better off waiting to see what that happens from a Bank of England perspective and how that feeds in than anything else. So no reason to push against hawkishness, and if anything, that means the risk is that that hike gets brought forward.
Sorry, just kind of thinking about inflation narratives back to the US, we actually get quite a lot of data out today, don't we, including PCE. But given that the last CPI print dropped, does that mean that the only surprise would be if we got a stronger PCE print?
Yeah, I think that's largely the skew in terms of, yes, we had that soft CPI print. It's also definitely fed into expectations for this PCE print. So year-on-year headline is expected to drop 40 basis points versus last month. Month-on-month is negative. So I think that's certainly the skew, and it's something we need to be watching because Warsh has told us that that data is what is really driving, and we'll get two more economic rounds of data before the September meeting. What I will say, though, is it's unlikely to completely derail the narrative, even if it's a downside surprise, because you're still at 3.7%, right? It doesn't mean that you won't get hikes eventually.
Skylar, thank you very much. Skylar Montgomery-Koning from our Bloomberg Markets Live team, setting us up perfectly, Guy, for the data out of the States later on today and also the Bank of England rate decision, of which we will have special coverage. Don't miss the BOE Decides. That's a special programme today, 12:30 p.m. London time.
Just selecting my lunch menu. OK, let's talk a bit about how these markets have managed their way through this morning. It's a really complicated morning. You've got the macro story, the top-down narrative, the Fed, what's happening with oil prices. You've got a whole series of earnings coming through, which I think are fascinating, and you're getting real divergence in terms of some of the performances that we're seeing both on the upside and on the downside. That's kind of cancelling itself out on this picture, but some big moves.
French construction doing really well. German athletics wear doing less well. Seems to be the narrative on European stocks this morning. That is it for the opening trade. The Pulse is up next. This is Bloomberg.